1 2 1 2. Excuse me. 1 2 1 2. Okay. I've got my new microphone. Well, it's not new, but I didn't realize my other microphone was so bad, so I'm using my call it the podcast mic because that's what it looks like. 1 2 1 2. Make sure the levels are good. Right. Good morning, everybody. It is the London Open, 8:38, and I'm going to start off by checking if there's news. There was at 8:30 for Euro. Other than that, it was just a president speaking, so it wasn't a value that we could kind of speak about. So we do have this tentative, just means it could happen anytime during the whole day. So we'll wait for that, I guess. But AD is in the morning. Something like AD, JPY would be good to be looking to trade, but I mean, realistically, it's going to stay in the same value. It rarely ever deviates from this forecast. Like here, it was once. It's rare, so you would expect it to stay about the same. Okay, so no news today. Last week seemed like a correction from NFP. Also, this website on some pairs wasn't accurate. It's 8.1. We can times it by multiples. We can look for it like GBP, JPY. What? I just have the thing. Something like this. Okay, cool. That works. We'll use it alongside this. Right, perfect. So no news. We've got the Forex calculators. This is DXY, right? So let's start on the weekly time frame. What do we see? So we see consolidation. We're still consolidating that in this range right here. Just make sure it's clear. We're kind of consolidating this range. What you would expect is that when we're in the premium, which is the upper half, we are bearish. When we're in the lower half, we are bullish until we get clear direction. So we are actually in the upper half. You'd expect some bearishness. So let's go to the daily time frame to see what that really means. So recently, from the discount of this specific range, we had the daily dip into this bullish fair value gap and then push up. And we were aiming for this imbalance, I believe, on the 4 hour, or is an order block. Okay, so I was expecting price to touch this and then reverse. It didn't reach it exactly and then came down. There is almost equal highs over here, which looked like it got taken out, and price is dropping now. Although it is dropping, we have this strong fair value gap here, which is this imbalance it looks to be filling out. And there is an order block right here. So at the order block, we could expect some reaction, and there's also an imbalance over here. So I would expect price to push up, and it could even come up as high as this imbalance to then come back down. It could continue down, which is unlikely because we'll have to pass through this fair value gap and order block. But it's also potential because of the fact that we've taken out swing lows and we are in a premium. When we have the weekly idea as well, that's also bearish because of the dealing range of consolidation. When we're in this upper range, we tend to be going down. So the only reasons for bullishness would be nearness of imbalance and resistance from areas of interest below us. So if we were to grab a notepad, yo. Sensitive information. So if we have, right. So for bullishness, and then we're going to have one over here called bearishness. What do we notice? So with the bullishness, well, near order block, probably another time frame, but near order block. These are the ideas of bullishness. Bearishness, weekly bias. We then have premium, multiple time frames, broken structure. These are kind of the main ideas. So we have bearishness, which has a weekly bias in the sense that we drew the consolidation range, and on the weekly bias, it looks like when price is above the premium or equilibrium, it is bearish, which is what we're in. It's also in the premium multiple time frame because that was weekly. On the daily, on the 4-hourly, we are also in this kind of premium. We then have the fact that we had this market short shift. You can see displacement from these candles here. We took out all these swing lows over here, right? So taking out swing short-term lows. We also had the market short shift to bearishness. We also had a displacement, which we highlight with that, and equal lows daily, which is this target down here, which still hasn't been, which is going to be a strong area of liquidity and still hasn't been taken out. So those are all the reasons for bearishness. Bullishness is that we're near this 4-hour order block right here. It's also that the imbalance of this bullish fair value gap has nearly been filled. And it's like, okay, well, if we're going to have the reaction to bullishness, well, it still has a little bit of range to go. The unfilled imbalances, although this is nearly technically one unfilled because it hasn't been fully filled, but it's mostly filled. Almost fully unfilled, we have one up here from the gap in the market from Friday to Sunday. So because of that gap, this is closer than, for example, well, this gap over here. It's like the nearest gap or fair value gap imbalance is here and here. So that's a sign for bullishness because price wants to go towards those areas. And then the fact that it didn't reach this 4-hour order block, which was our target for the potential reversal, kind of took out this high, but it's not really a swing high. It's kind of a fair value gap. So you could also argue that this is a bit of a weak point because the fact that we did actually reach the fair value gap instead, you know. But our target was obviously the order flow. So if I look at these 2 points for bullishness and bearishness, I'm more leaning towards bearishness. We have more in sync time frames, multiple time frames giving a strong indication. Each point is a strong point. This is a weak point. This is a weak point. This is a weak point. This is a strong point. So because it didn't reach the 4-hour bearish order block, but it reached the 4-hour bearish fair value gap. It has unfilled balances closer, but that's on a smaller time frame. The imbalance of the bullish fair value gap is nearly filled. It should be reacting from around the midpoint. We're not really seeing strong signs of reaction. The near 4-hour order block is strong because that is a strong area and it's order flow. So it could be also the sign of us pushing up into this area. So even if we're bearish, it could go straight down, it could come up and go down, but we're bearish is the point. So we're only going to be looking for sells concerning the dollar, right? So what you want to do every time you have a bias, when you're creating a bias, is you want to look at it for multiple time frames and create a picture. You're going to have things telling you it's bullish. You're going to have other things telling you it's bearish. No matter what market, it's going to be very rare for it always to be one way in multiple different perspectives. You know, it's like looking at a painting. right? A painting is going to be good to some people, it's going to be bad to some people, but you got to look at it from different perspectives. If you're looking at a painting, you got to look at it from, is it aesthetically pleasing? Then you got to look at it, okay, what was the techniques used by the painter? Then you got to look at it, okay, what is it depicted? What's the image? What's the story being told by this picture painted? Who painted it? When did they paint it? How long did it take? You got to look at it from different perspectives to then really come to a conclusion, whether it's a good painting or not. Because painting, I'm talking about it outside being a taste factor. It's like food. Food is based, everyone has different taste buds. So everybody will like different things, but you can still appreciate something that you don't like the taste of. For example, I can appreciate an avocado. I don't like avocado. I wouldn't really go my way to buy one. Never. I would never make it. If it's given to me, I may try it. But I don't like it. I personally wouldn't want it. But if people were to have it, I could understand it because I understand the appeal, because I look at it from a different perspective to my own taste buds. Now, obviously, these are kind of intricate ideas, because how can you appreciate food that you don't like? It's difficult, right? Because everything is in you is telling you that it's not nice. But when you change lens, when you change perspective, when you look at it from a different light, when you put on a different paradigm, you can see things differently. And that's what happens when you're in the market. You need to be able to see things differently to yourself. And so when I was doing that breakdown with the notepad, I was just showing you guys that it is possible to have price give you multiple ideas. Now, it's possible that you can use one to fund the other. For example, I said that it could go straight down, but I also believe that it's possible price comes up to fill most of those points, a bullish idea, to then go down. So I think something like this is plausible, because we do have points. Though 3 of them be weak, the fact that this 4-hour order block is present could be what pushes price up. And since it's pushing price up, it may target these imbalances, 1 and 2. And then after it fills that, that's 1, that's 2. That's 2, that's 3. So 3 of the 4 points for bullishness have been filled from price reaching here. And then guess what? All my bearish ideas are still in play. But because of that, it is possible that it goes up here and comes back down. So that's why I'm doing the arrows this way and not going straight down and looking for sales blindly. So this is what happens. Although we're bearish, you can also see that price can go up. And this is DXY, right? So if I'm selling euro, if I'm buying euro USD, which is selling the dollar, and it goes up and then goes down, what's that going to be? A liquidity sweep. So that's why we have the entry model to protect us from that. Okay, so there's 2 stages, the bias and then the entry model. Bias is direction model, which is finding out where the overall consensus of price, what's the underlying tone of the market, is done. That's the work where we put in on the larger time frames to really analyze price. We use tape reading, we use the underlying tone of the market, we use market information such as news, macroeconomic news, or data that we get from news release. We then also look at price action, which is a little bit linked to tape reading, and then we do that on multiple time frames, and we really look for, and when it comes to price action, tape reading, we use it in line with our ideologies, which is markets is looking for imbalances and liquidity. So when we take that philosophy and look at the breakdown the price in the market, that's where we line it up. Then we go to the smaller time frames and we look for an event happening. So we simply look for a sweeping of lows or highs, a reaching of a fair value gap on order block. And then once we have that event, we then look for the smaller time frames to show a confirmation that that event or that zone is a valid zone. For example, it reaches to our order block. We then want to see it make a market structure shift in the opposite direction on a smaller time frame to then cause our entry. For example, price came up to this 4-hour fair value gap, and when it came up to order block fair value gap, we swept a little bit of these highs. We then had a market shift in that we displaced below these swing lows, and then we look like we're continuing down. So this is enough for me to get in, and I would like for price to reach an optimal trade entry. And there's a fair value gap here, so I would actually want price to come up here to cause my entry, enter on the low hanging fruit around this equilibrium price. That's the lower bound of the fair value gap, and then that will be our entry targeting these daily lows, of course taking out some partials along the way. So that's our idea, that's how we trade. And this is obviously DXY, but we spend a lot of time with DXY because it accounts for multiple pairs. Everything with USD in it, it helps, right? You have USD JPY, Euro USD, GU, USD CAD, USD Swiss franc, USD I think I said JPY already, but all these pairs this has an effect on. So that's why we spend a lot of time here. So we spent 15 minutes streaming so far. Let us go over a couple of things, right? So Telegram, is a great place to start, because on my Telegram I post ideas, especially when I'm not streaming. I post all my trade ideas for free because educational purposes. I post my ideas. Now, I didn't update these trades, but I think most of them lost, actually, which is interesting. I was trading off my phone, as you can tell. I don't like trading off my phone. We did have this idea, right? So we had this idea here, and what did I say? We kind of missed the original entry, right? And we missed it because, well, I don't know why we missed it, but we had this range. Okay, we took out some of these swing lows. Price pulled back into this order block, which is lined up with this optimal trade entry. We entered, and we could see another reoccurrence. I think it's a 1 minute time frame. I'm not certain. Or it's 30 minutes. We see price displace again, taking out this. So I was willing to enter. I was scared that price isn't going to come back again, because it did it on the larger time frame and it did it on the smaller time frame. Why would they do it again, right? So I wasn't really expecting a third instance, and so I entered one over here with reduced risk. And this is where I got my GBP JPY incorrect in terms of lot size. I'll explain why later. So this was a 1 to 6, I believe. And then if it was this, it would be the 1 to 12. It was almost double the risk reward ratio. So because I didn't think price was going to come up, I entered in one trade here in case it didn't. And then I had my limit set. So as you can see here, optimal trade entries for price to pull back to the 30-minute for value gap, and then hit my entry. However, with how bearish the yen is, there is potential for it to just deliver without coming back. So I entered a small amount to accompany that fact. And then you can see here, price, this was my sell limit. It never came back up. Like I said, on the 30-minute, this displacement happened. And then from here onwards, it didn't come back up. But we entered here. You can see right here was our entry, just below this sweep of this swing low. And we rewatched, I think it was episode 2, where ICT Mentorship 2022 model, and he stated that it is okay to enter as we entered when we miss entry, but we have to account for the fact that our risk ratio will be different. So we ended up closing some of our trade. And what happened? We caught a 6 to 6 risk reward ratio, even though it was a late entry. So this second entry here, even though it was late, we got in at double the risk reward ratio, which is bad because we want half the risk reward ratio, which is bad because we want to make as much reward as possible to the same risk, and risked the same amount. But the problem is that on the account, when I did GBP JPY, you would actually be able to see it unless they've updated it, which I doubt. So it was like 10 pips. It's telling me that one lot for 10 pips is 72p. But if I was to go to another GBP, it then goes to £1. And then just to give you a good point, £58 on GBP CAD, GA 54. So tell me why GBP is this. So I'm assuming it's our by a factor of 100. So I think I did it by a factor of 10, which is the problem I did. Because I did it by a factor of 10, because I was thinking £7.20 is more realistic. I then got that wrong, because then when price delivered to the area, I don't know where my target was, but when price got to that 6 risk reward ratio, what then happened? We then had a factor of 10 less than what we should have, which is unfortunate, but it is what it is. For example, here, one lot size, 0.1, is £4.60. So this is wrong. So because one lot size is £4.60, I would have had to do more than that. I'm not going to show you my account side, even though I don't care, to be fair. Anyway, that was DXY. So this was the trade we took. It was 1 hour fair value up. We saw the displacement, but you got to be careful. Even though the model is what it is, you got to understand that price may not go all the way to your target. As you can see by the Telegram, we came out at 214.102. 214.102, which is around here. So we came out about close to the bottom. But this is a very messy chart, so let me clean up a little bit. Very messy. Let's just reanalyze it. So we had and the reason why I was even kind of passive is because GBP JPY, though is bearish, is showing some bearishness. The overall tone is what? Bullish. You can see it from bottom left. We've just been going up. You don't need to be a scientist to work that out. So that's why whenever I'm selling in a market that looks like this, I know it's a daily, I'm careful. I'm not holding to the extremes because why should I? When the market's tone is that of a bullish tone and I'm entering a bearish sell, I got to be careful. So that's the underlying tone of the weekly. Now on the daily though, the reason why we was confident enough to enter a sell is we have, for example, we have zones like this, right, where we have this fair value gap and we reacted to it. So I was able to enter, I think, some sells. So we reacted to it, yes, traded below some of these short-term lows, but we're now trading back up. So one thing is this, we filled this portion of the fair value gap. Normally, you would expect a reaction, which we have over here. Price came back up, and then we have this new dealing range from here to here. And this is what we use to enter, I think, some sells, but price didn't reach the extreme low. And I got around here, to be fair. Came up here, we exited here. Price is now taken out this high. We've this order block right range over here, we're above midpoint. I would say this is bullish, I'll be so honest. I don't like this for sells. And when I'm looking at it as a bullish light, I'm not really seeing the valid places for entry. Let me flip it market maybe. I'm not liking it. What I'll probably look for, like if I'm expecting to move up, I want to see a sweep down. Now, we kind of had it down here, to be fair, because these lows right here got swept. We had the shift, pull back. If we was to go from here to here, and the pullback just below equilibrium, probably a zone in here anyway, and then price looks like it's pushing up. So this all happened from this sweep, but again, I'm not feeling this. And I like doing analysis from the top down. I only really do for pairs that I was in last week or that I have an affinity to, which is trades I'm successful with on multiple occasions, or I like the look of or the feel of. Other than that, I'm going to show you a different method. I've done this before, but I'm going to show you again a method where I can analyze multiple pairs. Because if you look at my watch list, I have almost every pair under the sun. So there is a way to trade all these pairs very quickly, rather than doing top down, weekly, daily, 4 hourly, 2 hour, 1 hour, 15.5 on every single chart. There's a method I have where I can look for instances very quickly, like this. So GJ, I think the tone has changed. Though we were profitable in sales, I think the tone has changed. So here we was looking for sells as well. I was very bearish on a lot of the GBP pairs, but we didn't really get the execution that we wanted. So this is the time we use to reflect. Let me just quickly analyze to see if there's any opportunities, because it is coming up to 9:30 soon. Okay, so give me some sell opportunities here, which is interesting. Unfortunately, this just never came to entry. We have to be strict. Price never came to our entry. It came to our TP though. We had this displacement, or this taken out. Lower low, taking out this mark, swing low. Price came down here, but it didn't pull back far enough. This is not first imbalance, which is just above equilibrium. We set an alert limit, and price missed us by 5 pips, and that would have been 1 to 3. But we got to be disciplined. I don't care. Always, 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 no matter what. So that's why I didn't enter that. We could potentially have some continuations of that, so we'll keep that open. And the same thing happened here. Price came down, took out this swing low. Price came up, but I don't know if I was liking any zones in between. I didn't really see any areas of kind of like fair value gaps. Maybe I guess there's technically one over here, maybe could have used, but it kind of been filled already. It did touch it again over here, so it could have been a valid entry, to be fair. And then when did this happen? Friday 10th, would have been about 6 p.m. I would have actually been leaving my house at that point. But the trade would have been maybe something like this, targeting these equal lows, equal lows down here, which is a 1 to 9, to be fair. So this is good reflection. So it's okay to reuse fair value gaps that have been touched. I just didn't like it because I didn't like GBP and ZD that much. But okay, this could have delivered nicely. and they even traded it below a bit. I think what I'm learning is to trust my strategy more, if anything. Every time I do a reflector mode, which I don't know if you guys have heard the idea I had, which was study mode, market mode, and reflector mode. The most useful as a beginner is study mode, because that's where you learn your strategy, you test it on a demo account, you back test, etc. The only time an experienced trader uses that mode is when they're changing models or they're developing the strategy intentionally. The market mode is when you're trading live. It's the behavior patterns you have and showcase when you're live. Study mode, you have a lot of room for error. Excuse me. And in that mode, you can test a lot. You can be very, what's going on? Excuse me. In study mode, you can be very risky, very, get your urges out, because a lot of people that trade are actually gamblers. So study mode is that time to show you that gambling doesn't work. It's not a gambling industry. So you do all of those practice, whatever, on your demo account in the study mode. Study mode does not include live funds whatsoever. Okay. It's very imperative, because once you start introducing live funds into study mode, it then begins to get messy, and you then can lead into problems, which you don't want to do. The whole purpose of study mode is to learn, not to feel pain. Market mode is where you feel pain, if anything. But market mode is where you have extreme or strict rules, very, very strict rules concerning your behaviors or behavior patterns in the market. So market mode is where you, like you saw, when price didn't come to my entry, I didn't enter. I don't make any excuses. I have a rule book. It's clear. It's easy to be converted into words. Okay, that's what helps. Because when you have a very vague idea of what you're trying to do, it's very easy for vague counter ideas to enter your mind. Because when there's no set rule, then what happens when, oh, why not enter this? Well, of course you can enter that, because there's nothing saying you can't, because you don't have anything written down. So having strict rules is important to keep you in track. And sometimes it could just be there, and you don't really it's not like it's controlling you, but it's there as a reminder, if anything. Especially the more experience you get, you can trade without such. But I do recommend keeping it. I mean, if it's going to help you for one trade, it's worth it for me. And even if I'm a trader of 10 years of experience, I'm the best trader in the world, I've made this amount of millions, and there's a sticky note on my desk, my monitor, that helps me, I will keep it there. Even if I only look at it once, if any 100 trades, if it can help me for one trade in every 100 trades, it's worth having. So that's why I would recommend that. And then study mode, or rather reflect mode, is the times where it's going to be where you see the most improvement for an experienced trader. For example, you can see me going over the trades I took last week, and seeing what I could have done better. What happened? What did price do? And then making adjustments to my behavior patterns, because I was scared to enter on the second touch, because one, I'd lost a big trade. So I always reduce my risk for the following trades, which again is a rule. So even if I think I'm super confident, I don't enter the same risk. And it's good, because I lost again the following trade. So if I had lost twice, that's how you blow your accounts, when you keep risking the same, or you increase the risk every time you lose a trade. But for me, my rule is that. So that's from the market mode. But in the reflector mode, I can then look back. So you have to have confidence enough that it's okay. And you want a strategy, in my opinion, for me, I have to have a strategy that gives me a lot of opportunities every day, because it allows me to say, okay, even if I miss this opportunity, it's fine, I can get in again. Because when Bitcoin was low, I was one of the ones that was willing to invest thousands and thousands and thousands, but I didn't have the capital. And because I didn't have the capital, by the time I got even £10,000, I was already matured, and I had the vision of buying this a lot earlier, not like early stages where it was like pennies. I'm talking like when it was like low thousands, or like it was like 10, 20,000. And I was, or even around that kind of area. I was wanting to buy it to 100K, which it ended up reaching. So it was going to 10x whatever I put in, but I didn't have capital at that point. I maybe had like a couple thousand, which I'd put into other things later on. But I didn't have a lot of capital. And what was the point? Is that I was now scared of the next big thing, because I knew those type of opportunities were going to be rare. Bitcoin's not going to do another 10x for a while, if anything, if it even does it at all. So that next opportunity was, I couldn't see it at all happen. So I was really trying to get everything into this. what's my point? Where with trading, you get multiple opportunities. So you don't have to have that same fear. But you need to train your mind, especially when you're coming from things and pains and traumas as such, where you had an opportunity and you've never seen anything like it again. Maybe it was a 2008 crisis and you've not really seen that type of recession in that manner. Or maybe there was an opportunity that presented itself during COVID, which you didn't take, and you don't know when the next pandemic is going to be, if there's going to be one. So because of those uncertainties, you kind of rush and bring them into trading, which is not good, because you need to have you can find strategies that repeat itself over and over again. And so you don't have to have that fear. And I had to get rid of that. So that's one of the reasons why I had to kind of, change that mentality. But the idea of me not re-entering in again was due to my rule book of when you lose a trade, I have to find a perfect setup. And if there's one thing against me in the thing I don't like, I would not trade the trade. And I need to get rid of that because I just saw that it is a part of the rules where you can, because I do remember in the teachings of ICT Mentorship 2022 where the same fair value gap was used multiple times before it went down again. So it's possible. It does weaken over time, especially when it gets filled, but it can be used as another place of entry. Mamoon, hi bro, how are you? I'm good, my guy. Good to see you. It's been a while. We've been here every day, my guy. We finished the mentorship, and right now we're just live trading, and we're very confident with the strategy. I think NFP, we did 10x that week. Like whatever we put in, we made 10 times. Any buy sell zones for gold? I actually don't even trade gold anymore. Let me have a look though. I haven't traded this in a while. So I can actually break down the strategy for you. So on the weekly bias, I will start on the weekly time frame. We can see here we have a fair value gap here. Priced, use that just above halfway point to drop. It's created a lower low here. So there is some short-term bearishness. Obviously, we know that the underlying tone is bullish, but short term we could potentially have some bearishness. So I would expect on the weekly candle to be bearish again, but I would be careful because we did trade below this low and it's possible price comes up before it goes down. And then on the daily time frame, you can see that we are creating these low lows and we are kind of having that pullback. So I'll be looking for areas of selling. I'm bearish as the buyers, but this dealing range from this high to this low would be kind of the dealing range on the daily time frame I'm looking for. We kind of have equal lows over here. So there's some sell side liquidity below this area. We are pulling back over here. So what this Fibonacci is just me measuring optimal trade entries. So everything above 0.5, which is equilibrium, is a premium. And I ideally want to be selling in a premium. So that's my daily bias. So daily, weekly bias, I'm bearish. Obviously, short term we're bullish, but we got to be bullish until our area. So I'll be looking for sells from here downwards. Okay. So let me get rid of everything else so it's a little bit clearer. Within this range, there's multiple zones. You want to be ideally selling from 7.9 to 0.5. So there's a couple of things I'll be looking for. So there's this fair value gap here. I'll make this orange to show you the zones I'll be looking for sells. There's even one up here. Let me see what it looks like on the daily. Grab that zone here. I think these are the two main zones. So let's get rid of this area here. So we have two main zones I'll be looking to sell from this area here and this area here. Now this is obviously long term, so we want something a bit more short term. So let's go down into a small time frame. So I would be looking for the first area is this. The price come up here and then come down. Right? That's the first area of a sell. Now, why would I be looking for this? Well, first of all, weekly, daily, we established as bearish because we traded below these swing lows, created a low low, and there's some sell side liquidity. So we think this is the target. 4022 level, we would expect price to go back down here again. On the smaller time frames, we have this dealing range, which is the 4 hourly. We have this dealing range, and this would be classified as near the equilibrium. So although this is the first area, I wouldn't actually expect price to drop from here, but I'll show you what to look for in case it is. I would actually expect generally for price to come up here and then go down. But it is possible price returns down from here. But I have an entry model which would take care of that. So the way it works is you can see over here, there's some kind of equal highs over here. I'm just going to mark this area for now. So there's some equal highs over here. So I'll be expecting for this to get swept. So this arrow, I would expect price to come up above this green line to sweep it, which will sweep all of these highs. Then I would want a market to shift on a smaller time frame downwards. Once I get that, then I'll be looking for sales. But like I said, I expect price to go up further because this is just slightly below the equilibrium. So I would be expecting price to go up further and then go back down. But that will take a while. And that is personally my strategy. In terms of looking for buy into this area, I don't really see it. I don't like taking those trades. Those are counter trend trades. So I can't help you for that because it's not my strategy. If the weekly and the daily were cleanly bullish, then I could show you some buy opportunities. But for my personal depiction, the fact that we traded below this swing low here, we had a displacement to the downside, price returned to that displacement, and is showing signs of continuation by the fact that we had a lower low, I expect price to continue. So I think what would help you even more would be DXY. I analyzed this earlier in the stream, but let me just show you what I found. So on the weekly time frame, we are consolidating. So there's a little bit of uncertainty. There's opportunities for buyers and sells, but it just basically means there's going to be switching between buyers and sells very quickly. So you can enter buys when it's low, sells when it's high. It's obviously not that simple, but that's kind of the general gist of what you're looking for. So on the weekly time frame, you can see consolidation. So we expect that consolidation to continue, and we would wait for price to sweep either the high of the consolidation zone or the low, and then we can really enter a buy, a strong, solid buy for long term. But in the meantime, what I would say is just using that blue faint line right here is 0.5. When we're above 0.5, we're looking for sells. When we're below, we're looking for buys. So because we're above, we are looking for sells. That's from the weekly time frame perspective. On the daily time frame, we have this dealing range from 1 to 0. You can see that's the dealing range. And we drew this fib, which the 0.5 is the equilibrium. We are above it, so we're in a premium. A premium is where we want to sell. So on the weekly, we want to sell because we're in a premium. On the daily, we want to sell because we're in a premium. So this is DXY, which is the dollar itself. So we want to sell because we're in a premium. Cool. Let's zoom in a little bit more. So on the 2 hour now, we then have this new dealing range. Well, let's first analyze what zone that is. So on the 4 hours time frame, there's a 4 hour order block here, 4 hour fair value gap here. We came up into this 4 hour fair value gap. And once we reach this fair value gap here, we kind of swept these highs and we displaced downwards. And we took out this swing low. We took out this swing low with this displacement, which classifies as a market structure shift. So we've traded down below here. This is a 4 hour bullish order block. And we've nearly filled this 4 hour fair value gap. So now we come all the way up down here. We actually created this notepad, let me show you, of bearishness and bullishness. So the bullishness is that we're near this 4 hour order block, so price can go up from it. Then we have this imbalance of the bullish fair value gap nearly filled, which is this one right here. We've nearly filled it in the sense that we've nearly come to the bottom of it. So that is a sign for bullishness, because once you fill it, you would expect price to then reverse to the other side. We then have on-field imbalances closer than the bearish on-field imbalances. So for example, we have the Friday to Sunday opening gap right here. Whenever there's a gap or sell side liquidity, which is equal highs, equal lows, we expect price to go towards that, right? So there's this fair value gap, or not fair value gap, imbalance here. So I would expect price to want to fill it. And there's also some up here in the fact that we have this bearish fair value gap up here, which hasn't been filled. So there's two areas of on-field fair value gaps or imbalances. Whereas on the other side, there's this one over here, which is further away from price. So the closer, it's more likely for price to fill in. If you see them as magnets, it's closer to price. So price would probably want to fill these in first because it's closer, right? So because it's closer, that is a sign for bullishness. And overall, of course, bearishness, we have these two equal lows on the daily time frame and this bullish fair value gap. So for bullish ideas, we have these two zones to be filled. And then the fact that it didn't reach the 4 hour order block, which was what our target for reversal, which is there. So we didn't reach that. We only reached the fair value gap. So those are the ideas for bullishness. But we have stronger ideas. Some of those ideas are weak, right? But we have better ideas for bearishness. The weekly bias, the fact that we're in a premium on multiple time frames, we're in a premium on the weekly and the daily. We then have the market structure shift on the 4-hour time frame, which is this market structure shift here, taking out this low right here. Then we have the taking out of the short-term lows right here, the displacement in doing so, which is this displacement here, and then the fact that we have the better target of equal lows on the daily time frame. So that's our reason for bearishness. But the bullishness is the initial reaction to our optimal trade entry, because then when we zoom in, we have this new dealing range. We want to enter sells in the premium. And so what that would mean is that if price goes up to this zone right here, which is the 6-2 level marking the low of the 30-minute fair value gap, then we could start looking for sells here. So that's kind of our analysis on DXY. Now with gold, it's a little bit different. The reason why I haven't been trading as much is because of the wars that are going on. And I think they have such a huge impact on what gold does that I am not keeping up with the war personally. So because I'm not keeping up with the war, I'm not really trying to trade gold. Thank you so much, bro. No worries, my guy. So that was the dollar. So I guess you can say that because we're bearish on the dollar, we'll be bullish on gold. But it's a bit interesting because gold is giving me some bearish vibes by price action. I would say what's more important than DXY for gold would be the news, I think. And for that, I guess there's some people that would probably be better. Hold on, Twitter's a bit weird sometimes. Let me okay, I'll just make sure that nothing comes up that's not bannable. So there's a guy called No Limit. He does very well when it comes to news. There's probably some other people as well, but I'm not really too familiar. So I'll be honest, bro, I can't give you the best analysis, but I can show you what I do know, which is my price action. So I would actually be bullish on gold up until those areas I told you. Like I said, I expect price to come up here. So maybe you can be bullish up to here. But I don't really have any zones. That's the only problem. Trying to see if I can help you some more. Hold on. Yeah, I mean, I'll be honest, I would stay away from gold. I've been staying away from it for a while because there's mixed opinions. But yeah, hopefully that helps you at least somewhat. And then you can maybe do your own research or something like that. Okay, so going back to Forex now. Yeah, so this GJ trade was the one we took, posted on our Telegram. It was a 6 risk to all ratio, meaning that we got 6 times our risk. The only issue was the website we used gave us the wrong pips. So we made 10 times less what we should have, which is fine though. But it was a counter trend trade. So I wasn't really kind of chuffed to really be in such a trade. Now I think GBP JPY is bullish, but what's interesting is USD JPY has signs of bearishness. So let's have a look. So we're bearish on the dollar, which would show signs for sells. So this is very messy. Let me clear it up a little bit. We have this. I don't know what time frame I got this. Oh, it's probably 4 hour. Let's go and streamline it a bit more. So this on the hourly time frame is a, well, I guess hourly fair value gap. So let's mark that out. So this is the hourly fair value gap. We pulled up into it. We haven't come up to the midway point, but we came up to that maybe about 40% of the way, and we created this low, pulled back up to almost the high, created a low here. We pulled back up again, but we haven't come down to this level just yet. So if I was selling, I'll be looking for price to get to first this level, then this level. We created a low here and a lower low. You'd expect a lower low, right? Which would almost line up with this. Why do I say that? Because if you measure the distance from this to this, it's 21 pips. And what's this to this? Almost 21 pips. So if the lower low was 21 pips difference, and were to create another 21 pips difference, it would be equal to this low. So this would be the target. And how I did that without me knowing. I didn't know that was a different distance. Sorry, I just kind of used logic. So it ends up lining up. And one thing about the markets is that every time I analyze it, it is very articulate. Articulate is not the right word. It's very meticulous. The market looks random, and it almost is, but I believe there's a pattern to everything. And because there's a pattern to everything, once you understand it, when you look at the markets, when you look at it for a long time, you begin to spot these patterns. So the fact that price moved this distance and I expect it to move that distance again, and it lines up with this low, I don't think it's a coincidence. Doesn't mean price is going to go there. I'm just saying, right? So I'm bearish on the dollar. GBP, JPY though is giving me bullish vibes. So I do have to be careful with just selling it and buying the yen. Selling the dollar, buying the yen. So on the turn of the weekly, it's actually bullish. And you can maybe argue mixed. It's a bit different on the daily because we didn't create a high, number one. Number two, we had this big daily black candle, which is bearishness. And it took out some short-term lows. So it could be short-term bearish, long-term bullish. So daily is giving me more bearish vibes, weekly bullish. And then on small time frames, we have this 1 hour fair value gap. We also have this 1 hour open or imbalance, which we've filled, reacted from. It would be from this close right here to this open. Price came up to it. To be fair, it created equal highs. Might be a trap. Then we push downwards. We're in this bullish fair value gap. We'll start color coordinating these a little bit better. Let's do that for bullish and then orange for bearish. And this is just a weekend imbalance. And then this is a 15-minute fair value gap. Perfect. So we had this 1 hour fair value gap we came up to. We then created lower lows. We then have this specific dealing range right here from this high to this low. We came all the way up to that equal high, pass high, created equal highs, and we've dropped down into this 15-minute fair value gap. Now, I would be careful with selling this because we filled every imbalance. We filled this weekend gap. We filled this 15-minute fair value gap, and we filled it with this displacement itself. So price came back down here. It's possible price wants to go back up. I think I'm going to stay away from JPY because it looks bullish on the GBP JPY looks bullish, although we did just take out this swing low. Hold on, this is interesting. So I guess we swept this. Okay, this is a little bit interesting, right? And I'll tell you why in a second. Hold on. So we have our entry model almost being triggered, but we're looking for, so this is how I look for, as you can see, there's so many pairs on my watch list. I don't have time to do weekly, daily, 4 hour, 2 hour, 1 hour, 30, 15, all the time frames in sync in chronological order for every single pair because there's so many. So I have methods of analyzing the market like rapid. So then I can go bam, 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 skim through all of them. And then I can go backwards. So the way I work is that I look for my entry model. And if I see my entry model being triggered, I then go back to the higher time frames to see if there was a reason for the entry model. I can show you an example of when I did this and I didn't enter the trade. It was EuroCAD. I'm trying to find it. I may have deleted the drawings. Okay, no, it's right here. I'll show you. So we had this area which we wanted price to reach. I think we go from the 4 hour time frame, and we wanted price to come up here and then enter sells. But what would you notice? Price came almost to it. Almost to that zone, 7 pips. But because it didn't reach and it triggered my entry model, which is what? See the swing low, it got taken out with displacement. That's our first side. Because then from that displacement range, we then want price to come back up to the optimal trade entry, which would be this 7-9 level here, this fair value gap here. Came all the way up here and started to go down. So I would have been targeting down here. So price came up to our entry. And then what did you notice? It didn't reach our take profit. Obviously, I would have probably managed the trade and got out with some profit. But what's key about this is that it didn't reach the zone. So although it triggered my entry model, there was no reason for it. I zoomed out and the area of when it happened was along here, but you can see there's no imbalance along here. On any time frame I looked on every single time frame, there was no imbalance. And even if there was imbalance, it got fully filled by this. And this is a small time frame. I'm not using this. It's hourly and above. I'm not using this. I'm too fair. It's swept this completely anyway. It's been completely filled. So what's my point? My point is that I scanned the markets for the entry model and I looked back to see if there was a reason to trigger that. Do you get? So I look for the entry, which is here. It's a swing low being taken out with displacement, and then a pullback, which will be to my entry, which is where I'll enter to sell, right? But it didn't have I call it event horizon or an event happening, which is where on the hourly time frame and above, I would expect a zone like a fair value gap or equal highs or lows to be taken out. It could be an imbalance, sorry, not just a fair value gap. It could even be an order block. But I would need something to cause price to have this displacement change of character. But because there was nothing causing it, I couldn't enter it. And lo and behold, I probably saved myself some money. So that's how I quickly analyzed the markets. So you'll notice that I remember that because it was annoying. I was really wanted it. I think this was during their NFP as well. So yeah. Anyway, so what I do is I scan the markets in small time frames, and then I just scan through, look for, do I see a taking of a swing low? And then once I do see that, like boom, I see it here, GBP, JPY. We took out this swing low here. Is there a reason? Well, we had a buy side liquidity here that got taken. We created highs over here. So pretty much swept those. Then we had the sweep over here. Then what I'll do is I'll need a return to the optimal trade entry. Now, how do I determine which zone to enter? Because I remember I was looking at gold for one of my boys earlier, and I gave him 2 zones which price could use to go to the downside. How do I know which one is to use? Well, if you have 2, ideally, the safest option would be to use the most upper limit, the most highest zone. But if you always wait for the highest zone, this is for sales, you may miss the trade completely. As we showed with GBP, JPY, we entered the sell here, but we wanted price to come back up to this optimal trade entry, but price never did, and it delivered to wherever we took our take profits from, which was over here. So it delivered to our take profit, and it never came back. You can see it never came back up. This is the entry here. It never came back up. So it was a good thing we entered this trade, right? So there's 2 options. One, you wait for the most highest zone, number 1. Number 2, you enter in the lowest zone, but your stop loss is set as if price went to the highest zone. So you have a very wide risk-reward ratio, which I sometimes don't like. So if it's like ridiculous, like a 1 to 2, I would wait because I'm not really trading a 1 to 2. It's not worth my time and stress. So if that's the case, I'm gonna show you another method. So there's 2 methods. Those are like structured ones where if you're just trying to get used to the markets, I would advise you use the first one, which is to use the highest zone. If you really want to get into many trades, or you're not getting into many trades as possible, enter low-hanging fruit, but set your stop loss wide, as if you were entering the top zone. But there's another way. This is the most intricate way, which I use interchangeably with the first option. It is to wait. So go to a higher time frame. You see there's a zone here. Technically, there's an order block here as well. How do I know if price is going to reach this order block or if price is going to use this fair value gap? Well, for one, the fair value gap is below equilibrium. So I'd only enter the fair value gap from this point. So even though if it touches here, I'm not entering on the touch. It would have to at least come up to the equilibrium. And then you can set your stop loss above this high because you wouldn't expect it to go above the order block. So this would be entry number 1. But you can see I'm not trading this because the risk-reward ratio is 1.03. I only trade minimum 1 to 2s and above. Minimum. And even if it's a 1 to 2, I'll try to get it to a higher risk-reward ratio. So just by that alone would allow me to just enter only if it comes up to the order block, and then you go. It's higher than the 1 to 2, so I would enter this. Now the only issue with this is that sometimes you may miss the trade. But what do you notice? It's on a 50-minute time frame. So what I can then do is zoom in. So what I'll then look for is I'll look for another zone on a smaller time frame, and you can see this then turns into this fair value up right here, which is a bit more streamlined. It's in between the 0.5 and 0.62 level. So then I will look for price to come up, and sometimes, right, I'll do this thing where I'll look for my entry model again. So instead of just blindly entering, I will draw this range, and then I want price to come up to, for example, the 705 level, like here. And then I would want price to do what? To come up and then trigger another market structure shift and then retrace again. Now, this is very intricate, like I said, but it's basically doing the same entry model, but doing the entry model on the entry model. So the entry model, number one, which we did on a 15-minute time frame, becomes the market structure shift. So this is no longer entry, this is market structure shift level. So now our entry gets done on a smaller time frame. So that entry model that we did on 15-minute becomes where we look for the event horizon. Remember, we looked for the event horizon on the hourly time frame, but now we're shifting it to the right or left in this case. So what we did on the hourly time frame, we now convert that hourly to the 15-minute. So this 15-minute becomes where we expect price to now have a market structure shift again, but we'd look for it on the 1 minute. So it reaches the zone. Does it have the market structure shift on the 1 minute? And then if it does, we draw a entry range, and then we blindly enter on the imbalance or fair value gap it left. Like I said, it's very intricate, but it is the safest option and it's the rarest option. Like, it's hard for it to occur. Simplest thing to do is just to enter on low hanging fruit, which is the first zone above the equilibrium, which would be this area we've drawn here, which would be the 5 minute. I like to use the highest time frame it works. So it's the 5 minute fair value gap. And then I'll be looking for price to enter on the lower bound, which is the lowest for sales. It'll be the lowest part of the fair value gap. And I'll set it above the first candlestick contributing to the fair value gap. So this is the first, it's 1, 2, 3 candles. The first candle is this one, and the high of it is over here. And I'll just add a couple of pips for spread, and then of course volatility, depending on the pair and how it behaves. And then I would set my target to the previous low. So this would be something I would probably enter. It is just about 1 to 2, so I'll probably not really risk that much. I don't really like trading 1 to 2s. I like 1 to 10s, 1 to 6, 1 to 5s. Obviously, I don't always get that, but that's something I'll be looking for. So then all I have to now agree with is, am I happy with the event horizon? So we swept the buy side liquidity on this time frame. The underlying tone of the weekly is bullish. The underlying tone of the daily, though, is bearish. And the fact that we traded below this swing low here, we pulled back up into this fair value gap, and then we had an event horizon. So I would actually be very cautious, but I would probably be willing to enter low risk, just because of the fact that there is some underlying bullish tone to the kind of appeal of the market. So that's kind of how I would do back to front. So I am kind of teaching more this episode than I am trading. So let me just speed up the process a little bit. And well, we've analyzed GJ and USD JPY. So let me unmark everything else. Let's now go over the trades we took last time. So what I like to do is, like I said, start from the low time frames, then work up. But the exception is the trades I traded last week. I like to do a deeper analysis because I already have the idea of the bearish or the larger time frames in my mind since I traded it already. Wait, it's 9:30 already. I've been one for 36 minutes. There's no way. That felt like 5 minutes. Oh my goodness. Okay, let me look in. Because 9:30 is the time where we should expect entries. So I'm going to have to be a bit quick. All right, so let's teach in just more doing that. So we sweat this high, boom. Yep. I don't like that. What? How did that just move? Stay away from this. Okay, this looks a bit cleaner. So swept that, came back into the range, displaced, pulled back. Unfortunately, missed this entry, which happened on whatever, doesn't matter. What's price doing now though? Guess we can have another dealing range from here to here. Didn't really displace taking out this low though. I like displacements when we're taking out lows. No displacements here. I'm not a fan, but I'll put it in low interest. Euro NZD. Let's have a look. Okay, so we swept these equal highs, displaced back into range, pulled back into this area here. That would have been a sell opportunity to sell to here, which would have been perfect. It's similar to GBP NZD. Not really moving. It's moving quite lethargically, which means slow. I'm not really that interested. NZD CAD. We wanted price to come down. This was our target. No longer had that opportunity. We've reached the target before that's happened. The weekly bias, I don't like that at all. I have no idea what that means. Daily, I would say we're actually bullish because creating these high highs, high lows cleanly. So expect it to go beyond this area. We could get a short-term sell. I put in low interest. It's not anything clear right now. CAD JPY. This is how I trade very quick, by the way. I'm going to show you guys. So weekly, I would actually say we're bearish. Created this low, pulled up deep into this fair value gap. Looks like we're going to potentially have a reaction to it. Here we had the displacement. Took out these very short-term swing lows. But we have equal lows over here, which would be a nice target for some sells. We're just, I think, continuously making low lows, lower highs. We do have this extreme over here. Probably take it from here to here. We are consolidating a little bit, but I want price to come up more. I'll probably keep this in medium / high interest. But I would like for price to come up to the 705 level. Something like this. Put it in high interest, actually. That looks very solid. AD NZD. What? Okay, so we really can analyze this fight. Okay, boom, boom, boom. Okay, I get it. We'll keep a medium interest. We'll just keep the idea the same as well. GBP CAD. Oof. I remember these trades we missed. Unfortunate, man. I can't remember why I missed them, but I just remember missing them. So this one, oh yeah, I was probably in prayers, so I wasn't able to get this one. But this would have been first one. This would have been a limit I should have set at the 0.5 level. This order block. There's an order block. Generally speaking, I just set it to midway point as my entry as a limit. Stop loss just below the extreme of the order block and a couple of pips for spread. And I just target my area of liquidity, those equal highs here, which is why I really like this idea. This is a 1 to 6. You can see price eventually got there. And of course, you could have got in here as well. But we missed both, and both were 1 to 6s. So that's unfortunate, but it is what it is. I kept it there just as a reminder to trust and set limits, even if I'm not actually that confident. So this has been taken out. So do we have any other targets? Weekly, if we, I'd probably say bullish underlying tone. Here, I think there's equal high. I think I'll probably try and reach this bullishness. That's my target. We did just displace taking out this high, but the fair value gap is a bit awkward because of this large candlestick. The fair value gap is just here. Could actually be a reversal almost, but there's nothing really enough to say there is for me. That's too far away from price for my liking. I'll just put in low interest for now. It's a bit not too certain. Okay, what's happening here? So bearish on the weekly, bearish on the daily. We'll be looking for sells. Oh, so we came into this fair value gap over here. Displaced downwards, came back up. Looks like we want to continue down. So the only ways I can get entries. We have this dealing range from this high to currently this low. We need price to pull back fast for us to even get an entry. It goes to high interest. AD NZD, bullish, bearish, interestingly enough. I see the idea. We've already analyzed that. Euro USD. Remember, we're bearish on the dollar. The equal lows. I think this might be an order block. I'll say I'm bearish still. from NFP, we're just correcting. Put in low interest. Okay, GBP Swiss franc. So now that we've done all of those, we're going to go from Euro GBP on the smaller time frames. We're going to look for the taking of swing lows or swing highs. Technically, we took out this swing low right here. I don't know if LB. I don't know. I don't really like it. This is interesting. So we had equal lows over here. Swept tip displaced above. You probably wouldn't be buying down here. And it is bullish, to be fair. But this is medium interest. Only reason I say medium is because we're bearish on the dollar, which is interesting because this is bullish. Yeah. So this is kind of more of a continuation. Swap these equal highs, displace downwards. When it's a continuation, I like to look for the most recent leg. And then look for entries, but kind of already made this move. I'll just put it on low interest. Hello, taking out this swing low. This looks clean. This swing has been taken out here. And we've come up to this fairly up. Is there a way to shorten it? Okay, well, the shortest would be the hourly. This maroon. Yo, this is a wide fair value gap. But the idea is that we're in this bearish fair value gap. We took out the swing low, failed to create a high, displaced downwards. So essentially, I'd be looking for a retracement. But again, this is again buying the dollar, which goes against our DXY analysis. So it's very interesting to see. Maybe we got DXY wrong. We did kind of trade below the swing low, but I'm not really happy with the displacement, because when you compare this to something like GU, this is displacement. Not really, even this is kind of slow. Where's the strong one? It's not even that strong. Hold on, let me just quickly scan before I get distracted again. Okay, for now. Okay, so we can get rid of these. Now it's the decision of these ones. I think this gets to go to watch list. Oh, this was low. This is the watch list. I'll say low interest. I'll say about low interest as well. Skip, close those. Okay, so this is now us ordering everything in terms of high interest to low interest. Essentially, we just ordered it in terms of what we would like to enter, most likely. So high interest obviously being that of which we're most likely to enter. Why is Cat JPY here again? Oh, I just like the setup. It's just far from happening though. So I'll be low high interest, probably high medium interest. Let's go US Swiss franc. So everything looks good. It just needs, it's pretty much medium interest as well, I'll be honest. GU though, this looks very nice. It's a strong medium as well. USD CAD, a strong medium. This though, let's go below. GBP CAD. Are we bullish or what? It's that we have a short term, but what's the reasoning though? That's disgusting. Okay, we've gone 3 minutes over time. Just trying to really think. Got a lot of medium interest, but high interest is tough. All right, so just essentially it's a waiting game right now. I think New York Open will be a bit more interesting. We just want pullbacks, literally, on every single one of these pairs. Just a pullback, 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 pullback. So I'm going to be monitoring this off stream, but generally speaking, you want to probably pick your most favorite pairs. If you have the premium for TradingView, you can obviously set as many alerts as you want, depending on what program you get, I guess. But I would be looking for the best 3 and set my alerts. But yeah, I've this day we just pretty much went over our strategy, showed you a bit how I analyze the markets. Excuse me, and I did a little bit of reflection. I even helped myself. I forgot what pair it was for. I wish I did remember that, but it was when Price. I think it was one of the GPNs, EURNSD, I think it was, where Price used an old fair value gap to then just deliver from. So used it one time, created a low, came back up to that same fair value gap, and then used it again, which I ignored because of the fact of context of my account, not the trade, and I didn't enter it, and I would have got like a 1 to something ridiculous restored ratio. So there's that. When you're going for these higher restored ratios, you have to be almost perfect mentally with understanding your strategy and definitely psychology, because if you have a little bit of fear, a little bit of pain from maybe a losing trade, you will miss out, because to enter a high restored ratio trade, you have to have confidence in your stop loss entry and your take profit. You have to have confidence in everything. The moment you lose confidence in either one of those things, you lose the restored ratio. You may not lose the trade, you may not lose money, you may make money and good money too, but you lose the risk-reward ratio. If you, for example, have an entry where it's like, oh, it's a bit risky, it's a bit high, I'm not sure, I'm going against a trend, sorry. Well, there's a saying that the trend is your friend, but the trend is your friend until it's not your friend. So that's why you gotta be careful with the trend, because the trend doesn't actually have friends, believe it or not. The trend is friends with itself. You can pretend to be his friend by that you agree with everything it says, but the trend will always change at some point. And anything that changes, if someone switches up on you, you will not really classify them as your friend. But people try to force their way into friendship with the trend because of the fact that it sounds and rhymes. So just because something rhymes doesn't make it true. The trend is not your friend. I used to say that too, so I'm not making fun of anybody, but I'm just laughing out the pain I've suffered from thinking the trend was my friend, and then I got betrayed. And I don't do very well with betrayal, generally speaking, so I don't like it. And so when I get betrayed once, that's enough reason to X everything off. It's only because of God that I even can forgive. So I do get more than one chance, but I have very few in me. So the trend has broken my trust way too many times for me to trust it as a friend. But it doesn't mean I ignore it. I look at it, but I use it as, sometimes you got to keep your enemies close and your friends close, enemies closer. I'm closer with the trend now that we're not friends. When you're friends with the trend, you have a very love-hate relationship. When you're enemies, you know where it stands. You know where it's up to. When someone's your enemy, you research your enemy. You don't really research your friends because you just have trust. But when someone is someone you don't trust them or you don't like them, you probably know more about them than you would sometimes even the people around you. So that's why I place the trend as a frenemy almost. Anyway, that's why I don't think it's always good to go with the trend, because it sometimes can switch up on you. Now, what's this got to do with what I'm saying? Well, when you're entering a high risk ratio trade, it tends to be against the trend. So there's a tendency for those high risk ratios to be going against some sort of trend. Now, maybe in line with the overall trend on the higher time frame, but it'll probably be going against maybe the smaller time frame trend. So you kind of have to be careful in that regard. So like I said, the three things you got to be very confident in is the entry, stop loss, and the take profit. The entry is that you're going against the trend, right? So you have to be confident with the entry. Am I okay with this, right? Then the stop loss is, well, generally speaking, higher RRR is going to be a tight stop loss. You're going to have a reasoning behind it. Price can logically go to anyone's stop loss and go your direction, but you need to have a strong case as to why it shouldn't go to your stop loss. And it has to be as passive as it can be whilst being tight, meaning that it's as there's literally, if it goes beyond this line, this level, I do not want to be a part of the trade. And it has to be an instant flip where below that line, you're in the trade, you think it can go down. Above that line, it cannot go down based on your strategy. That's where the line has to be drawn. And it has to be something that's tight too. And that tightness can sometimes make you feel a bit uneasy because of 3 pip stop loss are very scary stop loss to set. But when you get experience, you realize, well, that's how the market moves in those ranges and those values. So you gotta get used to it. And then take profit. Well, if you come out early, you instantly, I guess, take out some of your risk ratio. Like I caught a 1 to 6, right? Because I knew price was gonna reverse. If you come out and price goes to your TP, that could have been a 1 to. Let me not lie. Let me actually find out what it was. If price delivered on the trade I took to 1 to 6, my original take profit, I didn't highlight it, but it was probably like a 1 to at least 10 or maybe 12. Let's say 13, right? So imagine here, I would have halved my profits. 6, 12, 13 divided by 6 is about 2. That's about half, right? So 6 is about half of 13, almost. And so because it's about half, if you come out early, prematurely, right, you are technically halving your profits. And if you're halving your profits, that risk reward ratio you entered initially is now halved. And so what does this mean? When you're entering these high risk reward ratio trades, you have to be confident in your entry, you have to be confident in your stop loss, and your take profit. The ability to hold a trade despite it being heavily in profit is not easy. The ability to enter a trade and it's going against a certain trend is not easy because of the indoctrinations of things like trend is your friend. To have a stop loss that is a single point where it is absolutely, you don't want to be in a trade when it goes above that line is, again, not easy. But I find having confidence in your entry and stop loss is the two most important things, because at least if you take profit, once you're in profit, it's very easy to be in profit when you have a high risk reward ratio trade and a tight stop loss and a good entry, because it moves 5 pips already, in what you risk, you already got back. So it's very easy, but it's now about trusting in those types of trades, like the ability to get out at a good level. And I think for me, one of the reasons where I get out early is to do a time where it comes up to maybe lunchtime and where I expect price to maybe reverse, and then my kind of coping, or it's not really coping, it's a cope, and it's not backed up by data. It's a mentality structure that I give myself, which is when I get out at lunchtime, I can potentially look for re-entries because I expect that period of time to be looking for liquidity. So I don't want to be liquidity. So I come out of the trade and I don't want to go into that drawdown. And I also sometimes look at my account and say, you know what, I'm happy with profits today. And even if it goes to my take profit that I initially drew out and it can get to, I'm happy with what I've got. So sometimes I have to have those conversations with myself, but I have systems in place, mentality structures in place, so where it's okay to do those things. And you would have to do that too. I'm not going to impose my ideas because my ideas are forever evolving. And that's what the purpose of a reflecting mode is to evolve. Evolving is different from studying, because studying gives you the understanding. Evolving gives you the intricacies, it gives you skills, and it gives you tools. And it gives you better decision making and data-backed decision structures, right, which you put in place, which somewhat you can get in study mode also, but reflecting, you're getting your data from a different point. Study mode, you're getting your data from practice, from demo accounts, from learning. Maybe you're watching someone's mentorship program, somebody else. So you're getting that from a specific data point that is already pre-established. But the reflect mode is getting it from your own data model, your own trades, your own behavior, your own entries, your own models, which is where you would use a journal to kind of keep track of the things you're entering, etc., etc. So they are almost the same thing, but they're using different models and they're in different stages, right? So it's quite detailed, this episode, but I think it's very, very impactful, because this is what, day 95? This is 95 days worth of trading experience and knowledge combined into 1 hour episode. So every time I trade, every new day is going to be an evolved day. That's why I say I keep evolving, because every day I trade, I'm learning something. I'm learning for myself. I'm learning from a mentorship. I'm always learning. Sometimes the market is the one that's teaching me. Right? I'm praying too. So sometimes the Lord is helping me. And in all of these things, every day I put my work in, I'm going to get better. Why would I not? I mean, think about it. I've been streaming for what? An hour, 20 minutes. Albeit most of it is teaching and showing. But there is also aspects of me learning. Like in the beginning, I was reflecting on my trade last week. So, you know, you got to kind of keep that in mind. I will not be publishing for a while, in truth, a mentorship program until I've shown myself to be faithful in this model, faithful in not just sticking to it, but faithful in results. That by me sticking by it and following it correctly, I'm able to teach it consistently. I'm able to teach it at a high level, low level, medium level. I'm able to teach it in multiple different facets and understand questions until I can now have no questions asked for myself. As in, I have any questions. I have questions with the model myself. Like, how should I treat an event horizon on the hourly time frame if the event horizon is maybe a liquidity sweep versus a pullback to a fair value gap? Or what is the difference in different currencies? How do I understand different pairs, underlying tones on a deeper level? The optimal trade entry I got from me starting 2023 mentorship, but then I went back to, because I was advised to go to the 2022 for the beginners that were learning liquidity and imbalances. So when we move on to 2023 and then 2024, there's actually so much information, and it's scary because it's like I feel like I know everything, but I know I don't. But it's like, what else could they possibly be talking about? So the fact there's over 100 episodes in 2023, and this is the basics, and I feel like I've got it down, and I feel like there's not much more. It's scary because that means there's so much depth to the market. Anyway, like I said, until I'm 100% comfortable and confident, I will not be doing any mentorship programs. I also probably won't charge for most of my stuff because I am kind of bringing them from places where they're free. Like, I'm not using paid data to learn or teach. That's why my live streams, they're going to be free. You know what I'm saying? So is what it is. But at the end of the day, I do need to earn a living, and I do like multiple streams of income, and I do want to give value to people that would be paying for mentorship. So if I want to give value, I need to gain value, and if I'm going to gain value, I need to be confident in that value, so that when I'm selling that value, people are actually getting their money's worth. Cool. So this is day 95. 5 more days to us, day 100, which would probably be next week, Monday. Wow. Day 100 next week, Monday, because I don't think I'll be streaming on the weekends. So I was meant to stream to 9:45. It's currently 10:01. We went 16 minutes overtime. We did start our day a little bit late. So I do have my calendar in front of me here, which generally speaking highlights my day. I will be free. I'll definitely be back on, I don't know about stream, but I'll definitely be on the markets for New York Open. But I'm going to keep my eye out on all these pullbacks, but they all seem kind of far away right now. So yeah, that's been it. It's been your boy CJIC. I'm going to close it here. And then I'll see you guys definitely tomorrow. If anything, I might even stream today. We'll see. Later today again, we'll see. But I appreciate everybody for tuning in. It's been good to see some old faces back, like Mamoon. Shout out to you. He was with me from almost day one, pretty much. I think let's just assume day one, like very close. So yeah, see you guys later. Enjoy the World Cup, enjoy the trades, and till we see you again next time. Peace.